So as we always do, and we should probably say it, please like, share, subscribe, especially share this if you find it interesting. But now that we've gone through that, we want to look at what is happening on the product supplied front. And this is, again, that demand piece. So you can see that we're holding pretty close to 2021 averages. We're not seeing too much of an adjustment. The current week was 14.576 million. Versus last week of 14.618. And again, it's just kind of that mixture of what was driving it. Here you had that bigger drop in gasoline, and you didn't really have much adjustment in distillate and jet. And we really think that gasoline is going to have a little bit of an increase, jet will have a little bit of a drop, and distillate's going to be holding kind of in this level. So we do expect to follow that 2021 average line fairly closely. When you look at where the white line is, which is 2022, we're really still below that 17, 18, 19 average. And we don't see that really being closing that gap, especially because when you look at 2021, it's important to consider that gasoline was still a bit of a weak spot, but you had a big, and I mean big increase, a huge increase on the distillate front and the diesel front. And now you're having a collapse in the, and I think collapse is the only proper way to describe it, in the trucking market. So because of that, you're going to get some of this shift in terms of what was really driving us higher in 2021 has now been mitigated and to be clear, to be very clear, it's still above 2020. It's still above 2019. So we're still elevated. It's just not going to be to the same degree. So that's where we think there's going to be that continued weakness when we compare even 2021 to right now. And a lot of that is obviously due to cost, which we'll talk about in a minute. So then when we look at distillate stock, again, had a nice draw of 1.45 million, 28.7 million below the 5-year average. And it's really that pad one that's still 17.9 million below the 5-year. And that's where we continue to see that pressure is on the East Coast. And with the limitations of what we can pull from Russia, which is equal to nothing, that's going to continue to be the case, and the shortfall is there. Pad 3 had a drop of 1.76 million, and you can see that 6.5 million below the 5-year average. So your Pad 3 has enough. Pad 1 is the problem, but Pad 3 is, and the Gulf of Mexico is looking at this and saying, whoa, that's some pretty great margins out there. So let's just continue to export it. Because remember, to go north, you have to go on the Colonial Pipeline, which is capped in terms of what it can run per day. And then to take obviously you could rail it, or to put it onto a boat. It has to be a Jones Act boat, very expensive. Given where prices are in New York Harbor, I'm sure it covers the cost. But again, that's why when you look at imports, as we were saying last week, we expected to see an increase. There was an increase of 21,000 barrels a day, just below the 5-year average, and we think it just holds at that 5-year average. The bigger point, when you look at storage here, you can see that we normally kind of flatline and start to go up. Here, we're still trending lower, and just given where we are, we don't expect the rate of change to accelerate to the upside. If anything, it kind of stops going down, but we're at such a low point that you're still going to be in a bullish backdrop. You're still going to have elevated pricing. You're still going to have a strong crack, especially when we're considering the disti cut. Production on distillate was fairly flat at about 30.5, but we did get an increase in the gasoline cut by about 1%. So again, those are things that are going to try to be managed, because refiners, especially when you start looking at Singapore, as we'll talk about in Pad 3, they're going to try to target that middle distillate cut as much as possible. Now, when we start breaking apart the different data on the product supplied, here you can see that distillate was fairly flat. You kind of get that drop and then that snap back up. We expect it to just kind of follow the 5-year average. We don't expect too much of a deviation. And again, that's on average, because you will go above and below, just given how it can be a bit noisy. But we think it's going to average out. We have on the heating side, you're not going to see too much. Cooling side, again, not going to see much. So it's really just going to be what is the diesel demand into trucking doing, and we don't expect it to be as robust. And here's what we're seeing. As you remember last week, we expected this to kind of flatline right around here, just given where we are. Now that we've kind of flatlined, we do expect this to gradually move lower and really come to that high point in 2020. So, you can see that you had that bump, the fade, and then that explosion on trucking demand when you look into 2020, and then as it continued into 2021. And we expected to come just below 100, really between that 95 to 105, and that's where it can live. When you look at rates are coming down again. As rates come down, that'll start to kind of flatline things because there's still stuff to move. There's still shortfalls in the supply chain, in the market. Yes, inventories are building as retail sales slow, but there's still going to be some of that movement, that shortfall that still can have support. Obviously, when you go back to 2014, things are still very elevated, but again, you're starting to see that slowdown from those highs. Still strong, still going to be some of that diesel demand, which is why, again, as gasoline is a bit weaker, jet fuel is a bit weaker, diesel was the driving force in 2021, and you're just not going to get the same type of demand. Still elevated versus the other previous years, but from previous years, talking 2014 to 2019, but not to the same degree. When you look at rail picked up a bit. We're still about 4.5% off of 2021. When you look at grains, forest products, coal, again, the harder comps, but still remaining fairly strong. Motor vehicle and parts elevated. If you think about how weak last year was, comps are a bit easier, so we do expect that. The intermodal side is the one that still remains a bit weak, just based on where things are going. We do expect it to pick back up, but again, not moving too much in this direction. Now, the bigger component that we want to talk about briefly is what's happening offshore, because when you look at when the lockdowns in China started, it's going to be a matter of when does it show up, and it's starting to show up in that week 19, May 8th to May 14th. And, when you look at May into June, that's when we're going to start to see that really big slowdown of cargoes coming from China into the U.S., especially on the West Coast. We're going to talk about it more in the Econ Show segment 1, so stay tuned. But again, this is going to be, I think, the bigger piece, and we expect more slowdowns coming as that pressure continues to mount, with really that first week of May being kind of that normal point. You can see it's still above previous week, slightly below previous year. But now as we go through May and especially into June, that's when we're going to see an increased slowdown. On the weather front, things are getting a bit warmer in the south, a bit cooler in the north. Things are fairly flattish when you look at the East Coast and when you look at the Northeast. So we don't expect, again, heating side, cooling side, fairly flat. So we shouldn't see too many pivots when we're looking at what is happening on the natural gas front. But more importantly, on the heating oil side, we're pretty much past that at this point in time. Now, as we pivot to gasoline, you can see gasoline had a drop of 1.57 million barrels. That's 9.6 million below the 5-year, but PADD 1 was the driver. PADD 1 had a drop of 14.8 million. 3.18 million, which is 14.8 million below the 5-year. Everywhere else, PADD 2 had a small drop, but PADD 3 had a build. PADD 4, PADD 5 all had builds. And this is where we see a much bigger import kind of flow coming from Europe into the U.S. market. So imports increased 163,000 barrels into PADD 1, 143,000 barrels a day into PADD 5. That's going to continue. PADD 5, there's more behind it coming from Asia. But PADD 1, because of that shortfall, we're going to be the best market in the Western Hemisphere at this point. And with Europe sitting on a record amount of gasoline, that's going to flow into the U.S. And we're going to see that really go above the 5-year average. Will be a little bit of a slowdown, but then we expect that to accelerate once again. Now, even though gasoline had a drop of 1.57 million, blending components had a drop of 960,000, and that's, again, we're getting some of that deviating points, and we'll see that continue to remain. And now when we look at gasoline is following the trend of the 29-year average trend, where you start to come down, you flatline, and then you have a little bit of a bump, and then you have pure driving season as we go into, again, June, and then more importantly, July and August are those core months where we get that drop down, and then things flatline as we get into September and October. So far, nothing too crazy on the storage front. One of the issues that we're continuing to see is the mobility. China has flatlined. We don't see China mobility improving and then when you go to Asia Pacific world, you can see that there was a fairly steady drop. Following, again, when you start looking at where things are on post the holiday season, this is where things will start to pick back up because you're going to come out of the holiday, but we're not going to see them get back to normal as we're looking in the Americas and Europe. And then Asia Pacific, that's one that has the most price controls. So as those start to weaken, that's where you start to see some of that pressure. And then when you look at the TomTom congestion, Asia Pacific, Europe, North America, you can see that TomTom is indicating that things are weakening. That's a bit of more of a leading indicator. And then the Google mobility, again, is where we see this really starting to come down. And again, this is going to put that pressure on that global market and that global demand on the gasoline front, and this obviously isn't helping. Gasoline prices are still above $4, flatlined a bit at $4.13. We see it staying at around this level, especially as we get into summer driving season and just summer grade gasoline, where you're kind of going to see this point. We had crude bouncing back over 100, so it's that like 90, 94 to 105 is where we've been sitting on the low end and the higher end at this point. But on the diesel front, we're bouncing back up. We're coming close to the all-time highs. Not quite all-time highs, but again, coming right back to it. Still over $5, $5.09, and a lot of pressure is going to remain in that market. This is what we were talking about with blending components. Even though gasoline had that drop, again, you're still seeing things on the blending side staying firm, very comfortable in those levels, and that will start to increase production but at the same time flatlining as you start to see some of these movements into the diesel, the gasoline pool. Now, when you look at where we are looking over the last 10 years, you can see that there's typically that increase. And again, it always comes down to timing. When does Easter fall? Because you have to kind of look at it piece by piece. So typically you have that big, nice spike that you have coming into Easter spring break, but we just didn't get it. And we're right at this 2013 number, and we're still sucking around. So there's still room to get an increase, and I just don't see us closing this gap, again, because of pricing, because of some of these adjustments. We've shown what people have said, what people are doing, and this is just another component where we don't see that same type of demand. On the U.S. front, you can see that things slowed down a touch. Obviously, for vacation, we'll start to pick back up. Parks will continue to grind higher as people try to take advantage of the nicer weather. But you can see workplaces are still 20% below normal, and we don't see that changing as people are still not going to the office. And again, remember, COVID is pretty far behind us at this point, even for the most protected areas, and we still don't have people going back to the workplace in the same way. And this is just kind of the indication that we've been talking about on that longer term hybrid backdrop. Now, when we look at propane had a nice build of 2.2 million, still 4.7 below the 5-year average, but you can see that the rate of change is accelerating. This is because, again, supply is increasing. We're getting a lot of, as we've talked about on the Frac Spread Show, a lot of targeting of the liquids cut. Still a lot of demand abroad. It's going to be lumpy, but again, this is going to continue to be a bright spot when we look at demand. Days of supply increased. You can see that it's just going to continue to go up because this is the seasonal build period. We expect this to continue as the rate of change kind of levels off and really tracks what we think is that 2017 level over the next couple of weeks. Jet fuel side, you can see that there was a build of 450,000 barrels. Now, when we look at where we are, we expect to be, again, between that 1.45, 1.55. So the very low end of 17, 18, 19 as we kind of go sideways. And the reason why we say that demand level on the jet fuel side is because that's where we are versus 2019. You can see that there is that very distinct drop where we're just not getting the same highs. We're getting lower highs, lower lows, and we expect to stay fairly firmly in this spot. And then as we go into the summer months, you see that 2019, 2021, you got that nice little move back up. It'll be the same thing, but just lower highs, lower lows, and that's going to continue to be the case. Week ahead is again also indicating things globally. 12-week ahead is 7.78% lower week on week, with cuts remaining minimal. Again, things are already showing up and just staying kind of fairly fixed. We're not seeing a huge add of aircraft. We're not seeing a huge drop off, which again gives us confidence with our discussion on demand levels. Open table still holding fairly strong. On the weekends, we're about 7 to 8% to about 15% better than normal. Weekdays, we're about 0% to 5% better than normal. And again, we just see that continuing at this point as people try to take advantage of the nicer weather. But as prices continue to rise on food, we do expect that drop off. But right now, this is kind of the only bright spot people have given the cost everywhere else. So I'm not sure how much people are willing to pivot away from doing it with the family, but the quality of it or the cost of what you're doing, where are you going to the nice burger spot or are you going to Applebee's? Nothing against Applebee's. Are you going to the the nice steakhouse or are you going to Outback? And these are some of the shifts that you're giving. You still want to go out, still want family time, but you're not going to kind of cut back on cost. And then once you go down that route, then you'll start to see that drop off. But so far, things still remain fairly stable on that front. So that's what we have for you in the U.S. In the next segment, we're going to kick off with China and really look at the global market when we're looking at products and crude.